Hello, everybody. Welcome back to Markets for Millennials to another edition of Investing 101, focused specifically on fundamental analysis. And today we're going to be using Google Sheets to look at the fundamentals of companies and use those fundamentals to build a watch list. And I just want to mention that this is specifically for you if you are a long-term investor. If you are swing trading or scalping, then obviously fundamental analysis is not for you. I also want to, as we shift over, I want to show you here. I've got a chart of Apple, and I want to also mention that fundamental analysis is for the investigation of the long-term viability of a company. If you are wondering where you should uh, where you should make a purchase of a company, then that is where technical analysis comes in. So the two work together. I've mentioned this in previous videos. If you are looking to buy a company, use the fundamental analysis to see if it's a company worth investing in, and use technical analysis to pick your levels for the right place to buy. So I'm going to shift over here, and you're going to see a couple of things on this page, and I will be explaining them to you as we go. I've got a Google Sheet, and it's basically two different pages. The first is the stock fundamental analysis worksheet, and this is obviously pertaining to one specific stock. Right here, I've got Apple up on the screen. But then what we do is we use this to look at a couple of basic fundamentals of a company to see if that is a company that we want to watch, which then we would import into our watch list, which will cover a number of those items as well. And we'll give you the opportunity to compare the different companies that you put in a watch list to to the average of all of those companies. So step one is going to be to find companies that meet certain criteria, and then the second step is going to be to use the watch list to compare the companies to the average, so that way you can find out what you should buy and when you should buy it. So we'll start off with just by looking at, you see I have Apple here, and just so you know, I will be posting this Google Sheet in the description of the video, so you can download it if you want to, and just so you can see it does work with multiple, basically every stock that you could possibly want to look up. So you can see here I put T, which is AT&T, Comcast, CMCSA. You can also see, actually I need to change this, just realized, boom. You can also, let's do another one. Cisco, that's in the Dow Jones Industrial Average. You could even look at Tesla. Tesla is one that I know is extremely popular, and so that's something that you might want to look at. Maybe we could do Chevron CVX. All right, so you can see that it will change. All the numbers will change for every stock that you put in the ticker. So, but I do want to also show you, for example, actually, let me go back to Apple and I'll start walking through what this information is. So, obviously, you have the company in bold, the number of shares, and the market cap. This is basic information. We have price pertaining to today. You have the current price, today's open, high of day, low of day. A lot of people like to look at those. You also have the change in price versus the previous day in dollars and in percentage. You also have the 52-week high and low. Also a section on the volume. So on this particular day, it is after the trading day is over, and you could see that the volume for today was actually higher than the average volume per day for Apple on this day. And then you also have yield, which is the dividend if the company pays a dividend. And obviously different companies pay different size dividends. So if I put in XOM for ExxonMobil, you can actually see that they pay $3.52 per year as a dividend yield, which is 4.88%. So obviously what you would do is you would take that and divide it by 4 because they pay quarterly. And then that's what you would be making quarterly if you invested in that. Also important to recognize when an asset does not pay a yield. So Tesla, for example, along with companies like Facebook and Amazon do not pay dividends, so that is something that you also want to be aware of. All right, so again, let me go back to Apple because that's the one that I've been using for this. And then you also have beta. Beta has to do with volatility. And so a beta of over 1 means it's more volatile than the average market or the average market listing. And if it's less, where, let me see if I can find, let me see here. See if I can find something that is lower in its beta. Yeah, so AT&T has a beta of under 1. That means it's less volatile. Typically, what I would say is a lot of times if you have a company that's been around for a long time and it's relatively low priced and it's not flashy, it's not one of the high flying tech stocks or whatever, typically you'll see beta for lower because you typically don't see the price move as it's not as volatile to the upside or to the downside as maybe some of the other stocks, and definitely as much as the average. All right, so now to look at the fundamentals, and so my base case here is that you should use, if you're a long-term investor, you should use the trailing 12 months fundamentals rather than the quarterly, because it's entirely possible that a company could have a really bad quarter or a really good quarter, and it may have little to no bearing on the actual company outlook in the future or on its past performance. One bad quarter doesn't make a bad company, nor does one good quarter make a good company. And depending on what the macro picture is out there, then sometimes the company can do really well in a specific quarter because of a macro backdrop. And then if things change in the macro backdrop, like for example, Federal Reserve changing interest rates, then that can affect a company's fundamentals. So we look at the trailing 12 months. And then the other thing is we don't look at everything. We try to look at things which will help to flatten or soften the picture, the overall picture. Because if you go to websites like MarketWatch, for example, I'm on the financials and on the cash flow. MarketWatch is where I am importing a lot of data from, but you could also import from Yahoo or Google Finance or from CNBC or Bloomberg, Morningstar, etc. But you can see though, if you actually look, if we go to try to go to our financials here, I'm kind of doing this freestyle here, and you load the income statement. I mean, you can see all of these numbers, and it's like, well, what's the most important thing? And the reality is that if you try to get too cute and focus on any one very narrow thing, then it may not give you the picture that is most accurate about the company. And believe it or not, there's not a lot of things that you really need to look at to really get a good picture of the viability of a company. And so the intent of this worksheet is to help you to get rid of a lot of the noise. So not only are we using the trailing 12 months because we don't have to worry about the gyrations quarter by quarter, but we also are only looking at big, broad fundamentals for the overall picture. So we focus primarily on in terms of the income statement or the balance sheet or the cash flows. We look at revenue. This is overall revenue, or a lot of people will call this sales. We look at the assets, total assets, by the way, and total liabilities. And the reason we look at these is because we want to know, like if you go again to MarketWatch, you can go find the balance sheet. And again, you can look at lots of very small things, but I don't want to know just the current assets or their cash or what their property is. I want to know all of it all together. So I'm pulling the total assets, and I'm also pulling the total liabilities as well. And then I'm using those to calculate the total equity, which is essentially the difference between the total assets and the total liabilities. And then I'm also pulling in free cash flow because I want to know, not operating cash flow, not any of those other cash flows. I want to know how much free cash a company has that it can use for reinvestment or dividends or otherwise. And typically, by the way, if a company has any free cash flow, let alone this is Apple, over 92 billion in free cash flow, then that means that it's more likely that the company's fundamentals are good, and that they have cash to burn in case of a drawdown, in case of wanting to do buybacks, share buybacks, which a lot of companies will do, and so on. So that's actually a good sign when you can see the free cash flow, that it even has any at all. And so that's a really good sign already. So those are the kind of the top baseline areas to look at. And then what I do over here is we have the earnings per share and the PE ratio, which are basic fundamental basic aspects of the fundamentals that people look at. I put these in here for control, not as a control group, not because I want to prioritize these, but because earnings per share can be manipulated, and the PE ratio itself could be misleading. So, but I will show you here. So what you do on the earnings per share and any of these that are per share is you take, in this case, the revenue divided by the shares outstanding, and that's what you get. You do the same thing with your assets and your equity and your cash flow to get these other functions. Okay, the PE ratio, you'll notice that it's highlighted in green, and the reason why it's highlighted is because typically an analyst would say that a PE between 15 and 30 is generally good. Now you have to take that with a grain of salt, because depending on the sector, the PE ratios on average in a sector could be higher or lower, and so that's part of the reason that we're going to have the watch list, and why I highly recommend that you not only create a watch list, a general watch list, but that you also create one by sector, so that you can compare PE ratios and all of these other metrics by sector. Okay. We also have the assets per share. So that's taking, again, the total assets and dividing it by the shares outstanding. Now, again, this is slightly better because the assets are based on, or the assets per share is based on what the company actually holds, real assets that the company actually holds, whether it be cash, buildings, property, or otherwise. But it still isn't a total picture because it doesn't account for the liabilities, right? We also have over here the enterprise value to Ebitda, right? And this is just another function, another tool which can be used to calculate whether a company is relatively expensive or inexpensive to buy. So obviously you want this number to be much lower than what you see here. And so everything in this column right here, before I explain the rest of this, everything in this column will turn green if the particular item that it's calculating is within a certain threshold that demonstrates the value of that company, or the relative inexpensiveness or expensiveness of the asset. So just want to mention that, right? We're also calculating the debt to equity ratio, and so we're essentially taking the number of liabilities and dividing it by the equity. You obviously want to see lower debt to equity ratios. You do not want to see company over levered, right? So this typically is taking into account the amount of leverage that a company is taking on. So I always like to, if I'm going to make a new purchase, I don't like to see the debt to equity ratio over 2. I'd rather see it under 2, and even better under 1.5, because if a company has good revenue, has good assets, and has good cash flows, and doesn't have to take out a lot of debt to fund its operations, then that's definitely a good thing. All right, I'm going to skip what I'm calling the true NAV per share, which you see I have a note here, book value per share. I'll explain that in just a minute, because I think that's probably one of the best metrics to look at. We have price to book. So that's taking the price of the stock of the company divided by its book value. And so price to book value here. And again, anytime these ratios are up really high, that's something that you don't want. And then obviously with the cash flow, we're calculating cash per share and price per cash. And you actually want to have the cash per share to be relatively high. So what I actually do is I have this set to turn green if the cash per share is actually higher than the earnings per share. Because again, earnings per share, you can do a lot of things to mess with this and to manipulate this. But if your cash flows per share are better than your earnings per share, then that's obviously a sign. And a lot of people be like, well, how can that be? Because again, your cash flows, you can have a lot of cash flows that come from various things that may not be connected to your actual revenue. And so that's so this means that maybe cash flows are coming from various incomes that are not coming from their actual business, but maybe from appreciation of assets, or perhaps other sort of payouts or other things. So it is possible, and so that's something that I like to compare as well. And again, that's based on free cash flow. So that's free cash flow per share. And then obviously calculating the price to cash flow. And so you actually want the price to cash flow also to be lower. So even though having cash flow per share is good, good cash flow per share, if your price to cash flow is not the right ratio, then obviously that's a disconnect. So, and then you can actually see the chart here. So if I go back to my chart, you can see that if I maybe zoom it a little bit, you can actually see that my chart is very similar that I have on TradingView to what I'm generating here. So by using this spreadsheet, you get all of these formulas and all of these different things. So, and speaking of, when you do the comparison, you notice, again, there are a bunch of different places that will turn green if certain metrics are met. So let me put in a different stock just to show you. So in this case, different cells turned green, right? So you also could do, let me see another one I did earlier, Cisco. Okay, you could do Honeywell. You could do Boeing. A lot of people were looking at Boeing one time, right? So, and I actually will need to adjust this a little bit, but basically, because I don't think this is actually calculating correctly now with my green cells. But anyway, I'll fix that by the time I post this. But because what you also want to be aware of is negative values. All right, you want to stay away also from negative values, because negative values. All right, you can see right here, Boeing is losing money. All right. Their total equity is down. Their liabilities are high. This is exactly one of those examples of a company where, which maybe was thriving at one point, but ever since, obviously we had the March crisis, we had the Boeing 737 Max problems and things like that. Boeing is losing money, and its debt to equity ratio is awful and all that. So again, like I said, I'm going to have to adjust these to make sure that they're not accounting for negative numbers. But losing money, that's all you need to know, is it's burning through money. So that's an example of how you can use this worksheet to avoid, some people actually, what, let me go back. I want to just show you, because some people would say, hey, Boeing was trading 52-week high, $278. Wow, 204, that's cheaper. Or some people would say, hey, if I pull up, let me just do this really quick. I'll pull up Boeing. People will say, hey, like before the COVID crisis, Boeing was trading in the upper 300s and low 400s. And there's a temptation to say, hey, like because of that recent history, it's bound to trade up that high again. And if you were to, use TradingView and pull the chart back, you can actually see that this era was only for a couple of years. But prior to that, the value had not really ever been that high. And so this actually, using this worksheet and looking at the cash flows in a fundamental analysis, will show you that this is not the right stock to go for. All right. So now, when you use this, right, and it spits you out a little chart so that way you can see, you don't necessarily have to go to TradingView. Um, but I include that in there because a lot of people like to see that. Um, so once you do that, if you go to the watch list, I've actually got Apple in the watch list, right? So let's say that what I do here is I'm going to go to Cisco because I know I've done that a couple of times. I want to go to Cisco. And maybe all of these are not exactly what I would want them to be at. I'm not getting a good consistent like read on the cash per share and the price per cash. But it's got a good debt to equity ratio and its PE ratio is good. And the true NAV per share, which actually I've realized I need to talk about the true NAV per share. So let me go back. I'll just use Cisco because I'm on it. Whoops. So I can show you how I'm doing this in real time. The true NAV per share, a lot of people refer to it as book value per share. And you find this by taking the total assets minus the total liabilities, which is where your total equity comes in, and dividing that by the number of shares outstanding. So in this case, the higher the true NAV per share, the better. A really high book value is great because that means that, and then obviously when your book value is higher, your price to book is going to be lower, right? And this is good because what this means is if the company were to go under, then this is the true underlying value per share of all of its assets. So if the true NAV per share or the book value per share is really, really low, then it means that your company is way, way overvalued. You're paying way more than you should. And I found that the true, I call it the true NAV because I think that it represents the real value of the company per share, or if you want to call it the book value. I think that the true NAV per share is the best metric that you can look at when doing fundamental analysis. Because a company can't fake its assets versus its liabilities. I mean, they could try, but something would look really fishy if you are calculating the book value and things are off, right? So the true NAV will actually do a better job of displaying disparities in a company's fundamentals than anything else. So that's why I find it to be extremely helpful. I apologize that I missed explaining that earlier. So anyway, so let's say, Cisco, this is a good company. It's got good cash flows, cash per share. It pays a dividend. Its PE ratio is appropriate. It's got a good debt to equity ratio. So what I'm going to do is I'm going to come over to the watch list, right? And I'm going to type in CSCO in the ticker, right? And so nothing happens, right? Nothing has happened yet. But the beauty is if you select all of these cells like I just did and then come to the bottom right corner till you get that plus sign, click and hold and drag it down, then those numbers are going to generate into each of those cells. And then what you notice too is on this sheet, it's calculating an average on the PE, on the NAV per share, on the cash per share, and for some reason this isn't working, but on the enterprise value to Ebitda. Because to me, the most important things that I want to compare again is I want to look at PEs only when I'm comparing them to the rest of the market and particular sectors. I want to know the book value per share in comparison to the average, and I want to know the cash flows per share. Cash flows per share to me are helpful because they tell me they tell me better, again, considering a lot of other things. Are they going to be able to continue to pay their dividends, and could they potentially increase their dividends? And could they do stock buybacks, which will in turn increase the actual value price-wise of the stock? So that's something that's, I think, really appropriate to look at. All right, so let me go back to the first sheet. So I'm going to check out another company. So I'm going to look at AT&T. Whoops, this should be a capital. Right, so you'll notice here we've got a really good match here, cash per share and price per cash. And even though, see, again, this is like the AT&T has a lot of cash on hand relative to its stock value. Um, they're still paying a solid dividend, almost 8%, in spite of having all of this free cash flow. Its NAV per share, when you consider its total assets versus its liabilities, rock solid. Relatively low debt to equity ratio. Again, it's under 2, which is okay, even though it's not triggering green because it's not under 1.5. I think that that's really solid. So even though their earnings have been falling, this is obviously, you could explain that kind of a situation to in a lot of different ways. And so to me, I still say AT&T is a good company. So what I'm going to do then is I'm going to go into my watch list. I'm going to add T. And then like I did previously, I'm going to take this and I'm going to drag it down. And then once again, you notice that these averages up at the top are going to change. And so if I'm going to do this just to show you how this will work. So let's say I want to add in, let me see, let's do Chevron. Let's do, I've already done Cisco. Let's do, excuse me, Comcast. Let's do Tesla. Let's do Microsoft, MSFT. Let's do Facebook. I'm just doing a bunch of companies that a lot of people know about, right? So I've got, let's see, I'm gonna try to put 2 more companies. Let's do Honeywell. Let's do 3M. I think that'll be enough. So we've got 10 companies in here. And what I'm going to do is I'm going to take this and I'm going to drag it actually down to cover all 10 of the companies. And so what you're going to see is, and again, the more companies you load in, this is why I think you should make different sheets per sector. So you can take this watch list and you can copy it and make it into new sheets so that you can do it by sector. All right. But what you can see here is, and it'll take some time potentially to load all of the data, right? But you'll see here again generating an average net asset value per share, average cash flow per share, and again I have to fix this, but I'll make sure I fix it. And then you can see here the average PE. So what you can do here is you can get a little fancy. You can change this formula to average, not accounting for numbers that are over a certain amount. Because what you notice here is you have Tesla, which is trading just massively over its earnings, price to earnings wise, and AT&T, which we saw earlier, also doing that, right? And so then what you could do here is, like, let's say that these are the 10 stocks you're looking at. Obviously, these 2 are dragging the average PE up really high, but if you eyeball it, 28, 20, 25, 15, 32, 21, 26, 17. So somewhere in the mid 20s, I would say, would be a good average if you did not account for these 2. So maybe if you're looking only at PE, then maybe you say no to AT&T and to Tesla, right? Or maybe not, because again, PE doesn't always tell you the whole story. So is Tesla super overvalued as it seems? Well, then if you look over at our NAV per share, again, which is our price to book value, right? The average that we're looking at here is 27,301, and now it changed actually because prices are changing as I'm looking at this, right? But you can actually see Tesla's NAV per share is actually much lower than the average. So it's not average by much or low by much, because again, if you look at Apple or Cisco or Comcast, those are all lower, or Microsoft, those are all lower, right? But then you also have a company like Facebook or Chevron, which are trading way above the NAV per share, right? So that actually helps you to see, out of these companies, if I was only going to pick 1 or 2, then maybe what I should look at is I should take Chevron and Facebook, right? But then also you look again at their cash flows. The average cash flow out of this list is 5.657 per share. And so what I want to know is how many is what's the average, and how do these companies compare? And so a company like Chevron has a low cash flow to share value. Tesla also, which is really interesting. So you're seeing how the picture changes when you start to look at multiple different fundamentals, right? And then you account for all of these things, and then you ask yourself, do you want a dividend to be paid? So maybe if it comes down to being between Tesla and Chevron, because we've got some different fundamental views, maybe you pick Chevron because its yield is really high. So so this is just one thing that you can do, one way that you can use this worksheet to help yourself when it comes to picking out a stock to buy for long-term investment. So hopefully this is helpful for you. Once again, thank you for watching. This is Investing 101 Fundamental Analysis, and I'll see you for the next video.